Hi, I'm Roger Conrad. I'm co-editor of Vital Resource Investor. And what I want to talk to you about today is the trends in the commodity markets as opposed to the U.S. economy. Now, historically, when the U.S. economy has sneezed, commodity prices basically caught the flu. And what that means is basically, when the U.S. economy is slowed, demand in the United States for vital commodities is slowed dramatically, and that's also played off into other countries as well. So the U.S. has been the real make-or-break item for these commodities, and that's in fact to such an extent that a lot of people have looked historically at prices of things like copper as leading indicators for the U.S. economy. And when copper prices have come down, they've said, well, Dr. Copper is telling us that which has the best PhD in economics ever, is telling us that the U.S. economy is about to slow down. And coming into this U.S. slowdown, which I guess in retrospect really began middle part of last year and is now accelerated into this year, and of course we've seen all the headlines and so forth. The expectation on Wall Street was that commodity prices would follow suit and again begin coming down in a big way. And in fact, we saw that happening with the commodity producer stocks in the latter part of last year, really selling off with a lot of other things. Now, commodity prices really didn't come down that much. And in fact, as we've seen coming into this year, commodity prices have remained very strong. Demand in other places has remained very robust. And I think this is something that the markets are now only beginning to digest, and that is the fact that the United States is still an important consumer of things like copper or platinum group metals or nickel or agricultural minerals or any number of things, but it's no longer the only consumer in the world, and in fact in many of them it's not even the most important consumer anymore. A little known fact, I think, that really bears on this in a big way is the fact that copper right now, Chinese copper demand is more than twice what U.S. copper demand was, and that's a big change that's occurred over the last 5 years. Chinese demand continues to accelerate even as U.S. demand continues to fall. So I think if you look at things in that respect, it's pretty easy to see that why these minerals have not dropped in price even as the U.S. economy is weakened. Again, first time in a very long time that's been the case. Demand in other countries remains very robust, and now we're starting to see that filter through into the stocks. And so a lot of these stocks are now finally starting to reflect the fact that maybe they are a little bit decoupled from the U.S. economy, even though that hasn't been the case for many, many years when the U.S. was the primary deliverer. So this is a really major event in the commodity business. I think it's extremely bullish for commodities. It's still quite possible the U.S. economy would get bad enough to bring down other economies and therefore hurt commodities that way. But certainly we're seeing a lot of resiliency, and that's becoming reflected in the prices of a lot of stocks. So, again, it's another crystal clear indication that things have changed in this industry, that we're in the beginning of, maybe not the beginning innings, but certainly the beginning stages of a multi-year bull market rather in basic commodities, basic vital resources. And that's very, very bullish for the stocks, and it's a good reason why you want to keep things in your portfolio like Freeport Copper and Gold or Rio Tinto, big companies that have proven that they can weather bad times. They're all takeover targets as well. I think we'll see more activity in that area going forward. Bigger companies can do the job of producing, meeting the still robust demand for all these commodities better than smaller companies. So a lot of very bullish signs, and again, these are things that I think you're going to want to have in your portfolio for a long time to come. So thanks for tuning in, and we'll talk to you next time.